Indo-China bilateral trade is a much debated topic of late due to the magnitude of factors ranging from challenges due to the import dependency to the business opportunities as global supply chain potentially shifts from China. Let's do a three-point analysis to understand how dependent is India on China. 1. Bilateral trade. China is India's leading trade partner and constitutes 9% of India's total exports and 18% of the total merchandise imports. Now, import dependency on China for a range of raw materials and also critical components is quite skewed. 20% of the auto components and 70% of the electronic components come from China. Similarly, 45% of the consumer durables and 70% of APIs, even 40% of leather goods are imported from China. 2. Make in India. Well, for some sectors, the impending supply risk and the policy shift towards self-reliance is likely to translate into Make in India or import substitution as it is called. In chemicals, amine players such as Balaji amines and alkyl amines, rubber chemical majors like Nosil, carbon black majors like Himadri Specialty Chemicals and Phillips Carbon as well, also engineering plastics company like Bhansali Engineering and such other companies in basic chemicals can gain traction because of the imperative to minimize the supply chain risk. Companies to look here are Deepak Nitrite and GNFC as they also remain beneficiary of the government steps to curtail import dependence on China. Now, in case of pharmaceuticals, import dependency for key starting materials or the APIs or the active pharma ingredients as they are called, these companies such as Aarti Drugs, Granules, JB Chemicals, IOL Chemicals would also be quite worth tracking. Now, in the consumer durable space, Havells and Voltas, which have recently stepped up in-house manufacturing facilities to reduce the import dependencies could also be on your radar. Now, in the auto equipment segment per se, Lumax Industries is setting up an electronics facility for localizing the component manufacturing over here. Also, the car maker or the leader Maruti Suzuki is also focused towards manufacturing various imported electronic parts now locally. 3. Supply chain shift away from China. Well, on the export front, the opportunity for Indian manufacturers is quite humongous at this stage. If there is a sizable shift in opportunities from China to India, that is. Now, a good portion of India's current exports to the USA consists of apparel, pharma, chemicals, vehicles and also furniture. However, except for a few sectors such as pharma, fish or sea creatures and even carpets, exports from China are several times more than that of India. Now, as per our estimates, out of the 1200 odd categories in which India exports to the US, there are 720 items where China caters to at least 10% of the US imports. Now, even if 5% of the US imports shift from China to India, in these categories, the opportunity size is as big as $140 billion. Now, if we look at countries beyond the US, China's wallet share in the imports of countries such as Japan, Australia and European Union ranges from 22 to 25%. Now, the gap between India and China in these markets per se is a bit higher. And so, notwithstanding competition from Korea and Taiwan for say high value added products and also Vietnam and Bangladesh, even Thailand for the low end products, the opportunity is still quite huge for India. Overall, this global set of supply chain is expected to bring a varied response from the Indian companies depending on their individual strengths.